Hey, good morning. This is May Valensky with Driving Markets, driving while talking about markets. Okay, so let's look. Remember, everything said in this piece is an opinion only. It's only media. It's not financial advice, not investment advice. And that is there to protect me. And hopefully, if you do make money, it's great. And if you lose money, then I won't get a lawsuit. Let's move on. So in driving markets, there's a lot to talk about. And obviously, the idea is to do a wrap of markets in order to give you a little bit feel of what's going on. I also like to throw in some education, but I'm getting a lot of messages from viewers saying, can you talk about this? Can you talk about that? Can you educate me? What does that mean? So what I'm going to do is I'm going to do a driving markets from studio, from a sitting standing point, and obviously that's going to be from the educational side anywhere between 15 and 20 minutes on YouTube, and hopefully that will cover a few more points in depth for those viewers who are looking to get a bit more out of this. So far the feedback is very, very positive, and I'd like you to share it with friends and share it with colleagues, subscribe and pass comments. I also have an Instagram account, so anything that you can do so you can get the message out there, it'd be most appreciated. So let's kick off with what's going on here. So yesterday, I apologize, there wasn't a driving market, but the retail sales of Target, which is a massive retailer in the States, were well below expectations. The shares fell on Wednesday by 13% when the numbers came out. So that is a poor indicator as to where the economy is going, causes concern amongst the retail sector. Yesterday, equity markets came off slightly. They've been off up and down the whole week. They're still solid from the consumer price index drop last week, and this week also the PPI, producer price index, which was down below what was expected, dropped below what was expected, and that also gave a little boost to equity markets. However, there's a little bit of mixed messaging going on as regards the governors of the Fed. For example, James Bullard of the St. Louis Fed said that interest rates are simply not doing the job and need to go a lot higher. So that is a message that's come out yesterday, and that frightened markets. On the other hand, you've got other governors that are indicating, some of them, that actually the interest rate cycle may be coming to an end. I don't think we're going to see an end in rising interest rates in the States before March. However, the markets have priced in a rate rise in December, but not yet priced in one in January. And if there is a significant rise in January, that will send equity markets going south again. My overall take on equity markets is that we are effectively going to go down. The trend has not been broken. There is indications of a recession. We'll go to that in shortly, and inflation is going to creep back up. It's not dropped. The trend has not finished. There is obviously this month, in November's reading, there was a drop based on October's inflation, but that was a one-off. I can't see the cycle going down. That's my opinion, and there's a lot of people are simply just convinced that the inflation has come to an end, and maybe equity markets have. It's already priced in for the future. Looking at the bond yields now, wow, this is an interesting one. The 10-year bond and the 2-year bond are inverted. In other words, you're getting a higher return on the 2-year than the 10-year, which is a lead indicator into recession. Why is that? What's happening? So the bond traders are seeing that within the next 12 to 18 months, the US and maybe the global economies are going to go into a recession. It's the lead indicator on this. The inversion of the 2-year and the 10-year has been correct all along since the Second World War. It's unlikely it's not right now. It's not right now. So what causes an inversion? So when investors invest in a bond, they're going for long term or short term. Now a long term investor is rewarded with a higher yield, a higher interest rate, a higher coupon, a higher return on their money, because they're taking a risk for long term. Whereas short term 2-year bonds will give you a lower yield because you're taking a lower risk only for 2 years. So normally the 10-year is higher yield and the 2 years a lower yield. I will go into this on an education slot when it comes to talking about bonds. Okay, just charging my phone, excuse me 1 second. That's it. Okay, so when the 2-year yield is higher than the 10-year yield, it means that investors are buying 10-year bonds for security and safety. They're willing to give up their return on their money for safety because they expect the global economy to go into recession and therefore the risk assets to fall. So they're taking money out of risk assets, putting it into safe havens like long-term bonds, which is causing the price to go up and the yields to go down, and therefore becomes inverted. I will go into that more on an educational slot. So that's something to be aware of, and that is definitely a lead indicator on recession. And it's not disappearing, it's actually getting wider. So we'll talk about that at another time. I've got to talk about FTX. So the administrators and liquidators of the second biggest crypto platform in the world, FTX, went in and couldn't find any assets. So now I've got to use forensic analysis and forensic accounting to find out where that money has disappeared. Where have the assets gone? It's all gone. $32 billion has gone, disappeared. And Sam Bankman-Fried is now being requested by the FBI and the authorities in the States to come for an investigation. This is going to send shockwaves and further uncertainty in the crypto industry. In other words, is your crypto holding safe where you're at? Everyone says yes, 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 but Gemini, massive platform, and its partner Genesis, with Genesis Lending, is stopping withdrawals on its loan platform. That's already sending insecurity amongst traders among the crypto sector. BlockFi is already planning a Chapter 11 bankruptcy filing in the US. Now you start adding all these platforms together. They're not the first ones. There's one of a series of platforms this year that have just gone bust or having financial difficulties, and the whole sector looks like it's complete chaos and a complete mess. So anyone who's trading cryptos or bitcoins, you've got to be very, very careful. Is the platform you're trading with secure? Are they safe? Can you withdraw your money? My opinion is that get your money out, see how the platform operates before you start putting any more money in. Crypto is a very hard to detect asset, and if that money disappears, what would be your claim to that particular platform? Yes, you can't hack into it, but as far as the platform going bust, where will your asset be, and how can you get your asset back if it's with that particular platform lodged on their account? So take that into consideration when trading cryptos. Looking specifically at foreign exchange, there's been dollar weakness this week on the back of last week's CPI high numbers and equity markets rising. As equity markets rise, the dollar will fall. Now, one of the biggest bullish indicators for equity markets is a falling dollar. And if the dollar continues to fall, or the DXY index, which is an index that measures dollar strength against all the currencies, if that index continues falling, that would be a boost to equity markets and would have the equity markets, which is the Dow, the Nasdaq, S&P, the FTSE, the DAX, the CAC, etc., all move up towards the end of the year. So you could end up, if the dollar continues falling, you could end up with a boost in equity prices. However, with uncertainty on interest rates and uncertainty on inflation, that's a dampener. That keeps equity markets down rather than flying forward. As regards particular shares, the Nasdaq is vulnerable to high interest rates, and some of the shares came off yesterday, the Microsoft, the Googles and the Metas. Remember, I'm a big seller of Meta Facebook. I'm still calling it down to $70 a share. Amazon, calling that down as well. There's other high-tech companies that are laying off a lot of people now as far as the industry is concerned. So you could see high unemployment in the high-tech sector. Remember, there's still a demand for labor out there, but labor at the truck driver level, at the service level, at the shop level, a lot of industries do not have spare labor, and one of them do have spare labor, and one of them is the high-tech sector. So keep an eye on that. The more layoffs there are, then the more trouble the high-tech sector is in. Overall, that's really it for today. You can subscribe, comment, share it, join my Instagram also. It's Meir Walensky with Driving Markets. Speak to you soon. Have a good day.